What really happened during the great financial crisis in 2008, and what were its lasting effects? In this interview, we'll delve into Brazil's story as an archetype, then broaden out our scope to the global stage to find out why it still has a grip on today's economy. In Brazil, the impact of the 2008 global financial crisis was relatively muted compared to other countries. Can you tell me a little about why that occurred?
Sure, so here are some key points regarding Brazil's experience during the crisis. Brazil's economy initially weathered the crisis better than many advanced economies due to its diversified economy, growing domestic market, and substantial foreign exchange reserves. Because of this, Brazil's banking system was more insulated from the toxic assets that caused turmoil in the US and European financial sectors. Its regulatory framework, developed after previous financial crises, helped maintain stability. Though Brazil experienced a brief recession in late 2008 and early 2009, its economy bounced back quickly, benefiting from strong demand for commodities, particularly from China. The Brazilian government also implemented stimulus measures, including credit expansion and infrastructure investment, to counteract the downturn and maintain economic activity. Despite these initial strengths, Brazil's growth eventually slowed in the years following the GFC due to factors like a decrease in commodity prices and internal structural issues. But the immediate effects of the 2008 crisis were less severe compared to many other economies.
I'm looking at the Consumer Confidence Index for Brazil, and it dropped 60% from 110 to 40 and never really returned.
Yes, Brazil's Consumer Confidence Index took a significant hit after the 2008 global financial crisis, and the drop you mentioned is an indicator of the broader struggles that followed. The decline from a level of 110 to 40 reflects a major loss of confidence among Brazilian consumers, and there are several reasons why it never fully recovered to pre-crisis levels. Key factors behind the drop and lack of recovery include several critical elements that intertwined to create a challenging economic landscape for Brazil. First, let's talk about the global commodity price decline. Brazil's economy was, highly dependent on exports of commodities like iron ore, oil, and soybeans. After the global financial crisis, global demand for these commodities dropped, particularly after the Chinese slowdown post-2010, which, significantly affected Brazil's economic performance. Then, we have government debt and inflation issues. In response to the crisis, Brazil's government expanded fiscal policies, increasing public spending to maintain growth. However, this led to rising debt levels and inflation, creating longer-term economic instability that honestly eroded consumer confidence. Political instability and corruption scandals also played a major role. The Lava Jato, or Operation Car Wash, corruption scandal that began in 2014 severely damaged the political and business environment in Brazil. This political turmoil, combined with multiple impeachments and governmental changes, negatively impacted economic stability and consumer sentiment. Additionally, Brazil went through a severe recession between 2014 and 2016, which caused unemployment to rise and consumer purchasing power to decline. This prolonged economic downturn was one of the worst in Brazil's history, leaving a lasting impact on consumer confidence. Although Brazil eventually exited the recession, its recovery was sluggish. Structural issues like high public debt, inefficiencies in the labor market, and political uncertainty prevented a strong rebound in growth. This slow recovery further hindered any significant bounce back in consumer confidence. In conclusion, the dramatic 60% drop in the Consumer Confidence Index and its inability to recover highlights how a combination of internal challenges, such as political corruption and economic mismanagement, and external factors like global commodity demand shifts, contributed to long-term pessimism in Brazil's economy. The CCI is really a good reflection of how deep and lasting the scars from both the global financial crisis and subsequent political economic crises were for Brazilian consumers.
Looking at the Business Confidence Index, by contrast, I now see what you were talking about. It seems as if there is an undercurrent of a growing, struggling population, while the business sector, or more affluent population, continue with the normal business cycle.
Exactly. And that's a key distinction between the consumer confidence and business confidence indexes in Brazil post-2008. The Business Confidence Index typically reflects how business leaders feel about the broader economic environment and the profitability of their industries, while the Consumer Confidence Index captures the sentiments of ordinary people regarding their financial situation and spending capacity. Here's how this disparity can be explained. Many businesses, particularly larger ones, can often weather economic storms better than average consumers. Brazil's large companies, particularly those in export-driven sectors like agribusiness, mining, and energy, benefited from global demand, even after the initial post-2008 shock. For them, despite domestic challenges, there was continued profitability. The more affluent segments of Brazil's population and business elite are often insulated from the broader economic struggles that affect the majority of consumers. Wealthy individuals and businesses can access better financial protections, international markets, and investment opportunities that help them maintain or even grow their wealth. In Brazil, political and economic policies, even during the crises, sometimes benefited the business sector disproportionately. For example, certain fiscal policies or tax benefits might have been directed towards stimulating business investment, while ordinary consumers faced inflation, unemployment, and stagnant wages. On the other hand, the Consumer Confidence Index captures how everyday people are struggling. Brazil's higher unemployment rates, rising inflation, and a reduction in real income over the years have created significant hardship. The recession from 2014 to 2016, followed by slow economic recovery, hit consumers harder than businesses, resulting in a prolonged decline in their confidence. Brazil has long been characterized by significant inequality, and that gap has likely widened in the post-GFC years. The business sector, particularly in more lucrative industries, can continue on a normal business cycle, while large portions of the population fall into economic stagnation or decline. This disparity reinforces the idea of a two-speed economy, where the wealthier sector continues to grow, while the majority of the population struggles. In summary, what you're seeing is a reflection of the growing inequality between different sectors of the population. The business sector might continue with the normal business cycle, adapting and benefiting from global trends and fiscal measures. Meanwhile, consumers, particularly the lower and middle classes, feel the brunt of inflation, unemployment, and wage stagnation, leading to their much bleaker outlook. This divide is key to understanding the broader economic and social challenges Brazil has been facing since the 2008 crisis.
It is pushed even farther, given the constraints of the monetary system that has $350 trillion of global debt that needs to be continuously rolled over, which needs constant GDP growth at any cost. The deflation in asset prices that is needed and would actually benefit the 99% would quite literally collapse the entire financial system down to the sand.
You've hit on a critical paradox at the heart of the global monetary and economic system. The massive accumulation of debt and the necessity for constant GDP growth to sustain it has created a highly fragile system where asset price inflation benefits the wealthy, but any meaningful deflation could threaten the entire economic structure. Here's a breakdown of the situation and its implications. The global economy is sitting on around $350 trillion of debt, more than 3 times world GDP of about $100 trillion. This debt includes government, corporate, and household liabilities, and it constantly needs to be rolled over or refinanced, often with new debt. To service this debt, economies need continuous GDP growth to generate the income necessary to make interest payments. Without growth, defaults would rise, threatening the solvency of the financial system. This creates a cycle where policymakers are incentivized to stimulate growth, often through low interest rates, fiscal stimulus, and monetary expansion, even at the expense of inequality or long-term sustainability. The primary tools used to stimulate growth, low interest rates and quantitative easing and QE, lead to asset price inflation. Stocks, bonds, real estate, and other assets rise in value as capital is cheap, and investors chase higher returns. This disproportionately benefits the wealthy, who hold the majority of financial assets. Meanwhile, the 99%, many of whom are renters, wage earners, or have limited access to capital, don't see the same gains. In fact, they may face higher costs of living as housing prices and rents increase, especially due to the financialization of the housing market and subsequent use of mortgage-backed securities as collateral for debt creation, which in turn tethered it that much more to perpetual trend of increasing asset prices. Asset price deflation, the reduction in the value of stocks, bonds, and real estate, would actually benefit the broader population by making housing and other necessities more affordable. It could also reduce wealth inequality by shrinking the asset base of the ultra-rich. However, a significant deflation in asset prices would create a massive debt deflation spiral. Since much of the global debt is secured by assets, falling asset prices would lead to debt defaults, bankruptcies, and a collapse in the value of collateral held by financial institutions. This could trigger a financial crisis that destabilizes the entire system, as happened during the 2008 crisis, but on a much larger scale. Low interest rates make it easier for governments, corporations, and households to service their debt, but they also encourage the accumulation of even more debt. This creates a vicious cycle where more debt is added to keep the system afloat, and the prospect of rising interest rates becomes ever more dangerous because it could make debt unmanageable. Central banks are in a bind. They need to keep interest rates low to avoid crushing debt payments, but these same low rates exacerbate inequality by driving asset price inflation. The system's reliance on constant GDP growth has pushed governments and central banks into a position where they must pursue growth at any cost. This includes environmental degradation, increasing inequality, and short-term economic policies that often create long-term structural risks. The global economy has become addicted to growth, and any interruption to that growth, whether through recessions, pandemics, or shifts in consumer behavior, threatens the entire system. The entire global financial system is now fragile, as it relies on maintaining growth and asset price inflation to avoid collapse. As you pointed out, any significant deflation would benefit the 99%, but it would also pose a catastrophic risk to the financial system. This is why policymakers often seem trapped. They can't allow significant asset price deflation, but at the same time, continually inflating asset prices only worsens inequality and social tensions.
One potential way out is large-scale debt restructuring or debt jubilees, where debts are written off or restructured, correct?
Yes, however, this is politically and logistically challenging and would likely face strong opposition from financial institutions and wealthy asset holders. There's a growing conversation around reforming the global monetary system to be less dependent on perpetual debt creation and growth. This includes ideas like moving toward more sustainable economic models, decoupling growth from debt, or implementing systems like modern monetary theory, MMT. However, these approaches come with their own risks and controversies. Progressive taxation, universal basic income, UBI, or more robust social safety nets could help redistribute some of the wealth concentrated in assets back to the broader population. However, these solutions are often politically difficult to implement.
Just to be clear, is this a widely recognized risk, or may we be coming off a bit exaggeratory here?
I can understand why you'd say that, and a little skepticism is always healthy, but I'm afraid what we've pointed out about global debt and the risks tied to perpetual growth is genuinely both a widely discussed and concerning issue among macroeconomic experts. People like Michael J. Howell, Raoul Pal, Ray Dalio, and many others in the macroeconomic space have been sounding alarms for years about the fragility of the system, and many share a similar outlook on the underlying structural problems. The sheer scale of global debt, as you pointed out, $350 trillion, is not an exaggeration, and managing this debt load has become a central issue for policymakers around the world. Howell, for example, talks extensively about global liquidity and how central banks are often caught between keeping liquidity flowing to sustain debt and the risks of inflation or asset bubbles. Figures like Raoul Pal highlight how central banks, through their policies of low interest rates and quantitative easing, have inadvertently created an environment where asset price inflation benefits the wealthy. These policies were initially meant to stabilize economies, but over time, they've contributed to widening inequality and made it harder for central banks to reverse course without causing a financial shock. Both Howell and Pal have discussed how the constant need for economic growth is putting strain on the system. Without sustained growth, debt becomes unsustainable, and defaults could cascade through the financial system. The idea that GDP growth at any cost has become a necessity isn't just speculation. It's a reality driven by the mechanics of debt repayment. This isn't a fringe view, but one that's broadly accepted in economic circles. It's become clear that wealth concentration has been exacerbated by the very policies that were meant to save the global economy from collapse in 2008. The wealthy, who hold the majority of financial assets, have seen massive gains, while most of the population has struggled with stagnant wages and rising costs. The debt deflation spiral you mentioned is a key risk that many macroeconomic analysts focus on. The idea that any significant deflation of asset prices could collapse the system is a recurring theme in the work of financial thinkers like Ray Dalio, Jeffrey Gundlach, and Michael J. Howell. These analysts see the current system as being on a knife edge, where even small shocks could lead to larger systemic problems. While the narrative may seem bleak, it's important to recognize that many of these macroeconomic figures aren't just predicting catastrophe for the sake of it. They're outlining the fragility of the system based on real data and long-term trends, while also suggesting ways that we could potentially mitigate these risks. For instance, Michael J. Howell often emphasizes the role of global liquidity and how managing that liquidity carefully can prevent a collapse. Raoul Pal frequently discusses the possibility of future technological revolutions, like blockchain and digital assets, that could help reset the system, or at least create new opportunities for growth. In a sense, yes, many of these issues are as serious as they seem. The system is unsustainable without major reforms.
Earlier, we discussed Brazil's initial resilience to the 2008 global financial crisis that masked deeper long-term challenges that would unfold in the years that followed.
Yes, so globally, this crisis set off a chain of events that led to massive inequality, inflated asset prices, and a reliance on debt-fueled growth, problems that have only been exacerbated over time. While Brazil initially weathered the storm, this wasn't the case for most of its population, who continued to struggle with the fallout. These global and local dynamics reflect broader themes of economic fragility, policy responses, and technological impacts. Brazil's initial resilience was short-lived. A diversified economy, strong domestic demand, and limited exposure to toxic financial assets cushioned the blow, and government stimulus helped Brazil recover quickly. However, deep structural issues emerged, leading to a sharp decline in consumer confidence, which dropped by 60% and never recovered. This was driven by a fall in global commodity prices, increased debt and inflation from expansionary fiscal policies, and political instability from corruption scandals, culminating in a severe recession from 2014 to 2016, with rising unemployment and eroded purchasing power. In contrast, Brazil's business confidence index remained relatively stable, highlighting a two-speed economy. While larger corporations in sectors like agribusiness and mining benefited from global demand and government policies, the general population struggled with stagnating wages, high inflation, and precarious employment. This pattern mirrors a global trend of inequality, where financial markets rebounded post-GFC, but ordinary workers faced long-term challenges. Central bank policies like quantitative easing inflated asset prices, benefiting the wealthy, while automation and globalization reshaped labor markets, displacing lower-skilled workers and widening economic disparities.
These dynamics align with broader theories of how technology and societal cycles are reshaping economies and global politics, as seen in Jeff Booth's The Price of Tomorrow and the Cyclical societal theory in The Fourth Turning. How do you look at this overall picture when also factoring in the very battle-tested theory put forth in the book The Fourth Turning, as well as Jeff Booth's theory of exponentially deflationary technology as put forth in the book The Price of Tomorrow? In my eyes, the constant technological progression ensures one of two things. Either deflation inevitably wins out, or it pushes governments towards hyperinflationary measures, which ironically may only appear in asset markets, again widening the wealth gap, as that very technology pushing the currency debasement to sustain growth at any cost has also made it possible for people to live more cheaply, and thus the inflation is masked by the technological efficiency.
It is worth noting that this book was written before the massive currency debasement of the COVID era, and before the emergence of large language models such as ChatGPT. I would say there could be some validity to this narrative, and possibly how much worse the problems have already gotten. The central premise of the fourth turning is that history moves in generational cycles, each lasting around 80 to 100 years, with 4 distinct turnings. The fourth turning represents a period of crisis, often marked by upheaval, conflict, and significant societal restructuring. The last fourth turning led to World War II, and according to the theory, we are now entering a new one, which began around 2008. In the context of today's geopolitical, social, and economic environment, this theory suggests that we are on the brink of, or already in, a major crisis, a point where old systems break down and new structures emerge. This fits well with the macroeconomic fragility we've discussed, a world straining under the weight of enormous debt, rising inequality, and increasingly fragile monetary systems. Hot wars, civil unrest, and global realignments are not only possible, but probable in the fourth turning. When you add the economic stresses, societal division, and global power struggles, like US-China tensions, a conflict or massive global shift becomes more likely. The debt levels you mentioned, debt to GDP at wartime percentages, reflect the economic reality that usually accompanies this phase. Societies take on extraordinary measures to manage crises, often through warfare, radical economic policies, or revolutionary technological change. Booth's thesis in The Price of Tomorrow posits that technology is inherently deflationary, and that we are entering a world where exponential advances in tech, AI, automation, renewable energy, etc., will reduce the costs of goods and services dramatically. This technology-driven deflation poses a massive challenge to the existing monetary system, which relies on inflation and perpetual growth to service debt. Technology, by lowering costs, increases efficiency, which in turn reduces the need for human labor, drives down wages, and fundamentally reshapes consumption patterns.
As I recall, Booth predicted that this deflationary trend would either force central banks into hyperinflationary policies to protect the economy from deflation, or accept deflation and allow widespread economic restructuring.
Well, with the massive currency debasement we've already seen post-COVID, with trillions of dollars in stimulus, we are witnessing an acceleration of Booth's predictions. We already know which choice has been made. Hyperinflation may not have hit consumer goods yet. Maybe it never will. But asset prices, stocks, real estate have ballooned dramatically as a result of these policies. Technology's deflationary impact is also evident in how AI, such as large language models and automation, are rapidly transforming industries. AI, for instance, can cut costs in education, healthcare, manufacturing, and even financial services, making it possible for people to live cheaply despite currency debasement. The tech sector is rapidly eroding the demand for certain kinds of labor, creating a mismatch between technological advances and the traditional economy.
Deflation versus hyperinflation, the battle for the future. This leads to a crucial dynamic. Deflationary forces from technology are clashing with inflationary policies from governments and central banks. The system is being stretched between two extremes: deflation from technological advances, making many goods and services cheaper, and hyperinflation or inflationary pressures in asset markets due to easy monetary policies and currency debasement. Booth's view suggests that central banks will continue to pursue inflationary policies to counter deflation, which could ultimately lead to hyperinflation, especially in asset markets. We've seen this with skyrocketing housing prices, stock market rallies, and increased wealth concentration among those who own assets. At the same time, AI and tech advancements are making it possible for the average consumer to live much more cheaply in certain areas. Think of how software, automation, and renewables have lowered costs. This exacerbates inequality because, while consumer goods and services may become cheaper, assets like housing, stocks, and real estate remain out of reach for many, creating a divide between those who benefit from asset inflation and those who don't. The fourth turning will influence future social and economic policies as well as political outcomes. Although crises tend to begin as economic, this then leads into social, which then leads to political. Can you explain how this progression takes place?
Certainly. Economic instability often leads to political polarization, social unrest, and in some cases, war. This fits with the current era of populism, geopolitical tension, and rising social unrest we're seeing globally. As we mentioned earlier, with wartime levels of debt to GDP about 7%, the US and other countries are likely facing another major global conflict or geopolitical realignment. Historical fourth turnings often coincide with wars or revolutions because that's when old systems are replaced. With the added complexity of today's technological disruption, it's plausible that we could be on the verge of a technological Cold War, a global conflict, or at the very least, major shifts in power dynamics, such as US-China tensions and regional conflicts.
Let's try and put this all together so far. Technology is creating massive deflationary pressures on a system that requires inflation to function. The technology is making it cheaper to live in some ways, while simultaneously reducing the need for human labor and pushing many into precarious economic situations. Governments and central banks are fighting this deflation with inflationary policies, leading to inflated asset prices, currency debasement, and growing inequality. At the same time, we are in a fourth turning, a period marked by deep societal crises, which often lead to wars, revolutions, or major political and economic realignments. Debt levels are at wartime highs, geopolitical tensions are growing, and the existing economic system is under strain from multiple directions. Together, this suggests we are heading toward a critical inflection point where the old economic and social systems may be replaced, either through technological transformation, conflict, or both. The battle between deflationary technology and inflationary monetary policies will likely lead to significant shifts, and we may soon see what the new system that emerges looks like.
This truly is a convergence of historical cycles, economic fragility, and rapid technological disruption. The deflationary impact of technology on top of an over-indebted system, combined with the inflationary pressures from central banks and the cyclical crisis outlined in the fourth turning, points to a pivotal era of transformation. Whether we see hyperinflation, deflation, or some other outcome will depend on how these forces continue to interact and what steps are taken to address them. The challenges are immense, but understanding these dynamics gives us a clearer view of where we might be headed.
Given everything we have discussed today, what are these cycles, these shifts in economics, politics, and society telling us? What does the next decade look like? What can we expect to see moving forward?
Well, based on the backdrop of debt-driven economic fragility, deflationary technology, the fourth turning cycle, and other dynamics discussed, there are numerous large changes that are likely to take place. Global debt crisis and major currency resets, 75% probability. As global debt continues to spiral out of control, we will likely see a debt crisis that triggers currency devaluations or even currency resets in major economies. Central banks may struggle to maintain control, leading to significant restructuring of the financial system. This could involve a transition to new monetary systems such as central bank digital currencies or the repegging of currencies to assets like commodities or technology. Widespread adoption of central bank digital currencies, or CBDCs, is highly probable, with a 90% likelihood. To maintain control over increasingly unstable financial systems, CBDCs will likely become the dominant form of currency in many major economies. Governments and central banks will push for digital currencies to enhance monetary policy tools, track economic activity more closely, and manage the fallout from currency debasement. However, this could raise concerns over privacy and government control. Hyperinflation in asset markets has an 85% probability. As governments continue to pump liquidity into economies to stave off deflation, hyperinflation is likely to take root in asset markets such as real estate, stocks, and commodities. This will widen the gap between the wealthy and the poor even further as asset prices skyrocket, while wages and consumer prices rise at a slower rate. Homeownership, as difficult as it may seem already, will become even more unattainable for the average person. Technological unemployment becoming a major social crisis has a 70% probability. Advances in AI, automation, and robotics will displace large segments of the workforce. While new jobs will emerge in tech-driven sectors, the pace of job creation will not keep up with the speed of disruption. Technological unemployment will become a significant issue, potentially leading to large-scale social unrest or the introduction of policies like Universal Basic Income, or UBI, to address the growing discontent. A major global conflict or hot war has a 60% probability. Given the tensions predicted by the fourth turning and increasing geopolitical rivalry, particularly between the US and China, a significant global conflict is likely. This conflict may not resemble traditional wars, but could involve cyber warfare, technological supremacy, trade wars, or limited military engagements over key strategic regions like the South China Sea or Taiwan.
An event like that could certainly reshape global alliances.
Yes, and potentially accelerate changes in economic power structures. Accelerated adoption of renewable energy and energy storage has an 80% probability. The transition to renewable energy, driven by solar, wind, and energy storage technologies, will accelerate throughout the 2030s. As deflationary forces in energy take hold, fossil fuels will become increasingly uneconomical. This will result in widespread adoption of decentralized energy grids and clean energy solutions, particularly as governments face mounting pressure from climate change. This could also drive down energy costs in real terms, contributing to the deflationary pressures Jeff Booth describes. Revolutionary advances in AI and biotechnology have a 95% probability. The 2030s will see a leap forward in AI capabilities, with AI systems becoming more integrated into everyday life and industries. General AI, if not fully achieved, will approach near human intelligence levels, radically transforming healthcare, finance, education, and scientific research. Biotechnology will also advance rapidly, with breakthroughs in gene editing, synthetic biology, and longevity research, extending human life expectancy and changing societal structures around aging and work. Increased social unrest and political polarization, with an 80% probability, is on the horizon. Rising inequality, economic disruption, and technological unemployment will lead to increased social unrest across many countries, particularly in Western democracies. Political polarization will deepen as more people feel left behind by the economic system. Populism will continue to rise, and governments will struggle to find consensus on economic and social policies. Expect ongoing protests, civil disobedience, and the rise of fringe political movements. Massive investment in space exploration and colonization, with a 65% probability, is expected. With major advancements in space technology and a decline in the costs of launching missions, space exploration and the first steps toward colonization, likely on the Moon or Mars, will become major focal points in the 2030s. Private companies like SpaceX, Blue Origin, and others will lead the charge, with governments playing key roles in regulation and strategic investments. A new space race could emerge as both a political and technological competition, especially between the United States and China.
Now that'll be an exciting time.
As centralization in finance, technology, and politics continues to produce instability, a growing movement toward localization and decentralized systems will emerge. Technologies like blockchain, local energy grids, and decentralized internet infrastructure will enable communities to become more self-sufficient, potentially bypassing traditional governments or global systems. This could lead to both positive outcomes, such as local resilience, and negative ones, like the fragmentation of global governance. So let's recap the key points we've covered. First, there's a 75% probability of a global debt crisis and currency resets. Next, we have a 90% likelihood of widespread adoption of central bank digital currencies. We also discussed an 85% chance of hyperinflation in asset markets. There's a 70% probability of a technological unemployment crisis. Additionally, a major global conflict or hot war has a 60% chance of occurring. We see an 80% likelihood of accelerated renewable energy adoption. Revolutionary AI and biotechnology have a very high probability at 95%. Increased social unrest and political polarization stand at 80%. There's a 65% probability of massive investment in space exploration. Finally, the shift toward localization and decentralized systems has a 70% probability.
These predictions, based on the combined forces of technological advancement, economic instability, societal cycles, and geopolitical tension, suggest a decade of profound transformation and potential upheaval. The probability assignments reflect both the emerging trends and the inherent unpredictability of crises like war or revolutionary technological breakthroughs. The key theme is that deflationary forces from technology will collide with inflationary pressures from monetary policy, shaping a world that may be radically different by the end of the 2030s. The global economic landscape has faced significant challenges since the 2008 global financial crisis, with deep-rooted inequality and financial fragility emerging as key themes. As we discussed previously, Brazil's experience encapsulates much of this, from an initially strong response to GFC shocks to a prolonged period of economic and social struggles. Their steep drop in consumer confidence in stark contrast to business stability, highlighting a larger pattern of inequality between wealthy asset owners and the general population. Worldwide, post-GFC recovery has primarily benefited financial markets and businesses, while the working class has dealt with stagnant wages, inflation, and increasing precariousness in employment. Central banks' policies to maintain growth and service mounting global debt have kept interest rates low, driving asset prices higher, further concentrating wealth among those who already own capital. This has set the stage for an era of unprecedented economic, technological, and social change. When integrating theories from works like William Strauss and Neil Howe's The Fourth Turning, Jeff Booth's The Price of Tomorrow, Ray Dalio's The Changing World Order, Michael J. Howell's Capital Wars, and Raoul Pal's thesis on exponential technology and blockchain, the global picture becomes more nuanced. The Fourth Turning proposes that society undergoes cyclical upheavals every 80 to 100 years, with the current period marked by crisis, breakdown, and eventual transformation. Booth's theory emphasizes how exponential technological advances, like AI and automation, are inherently deflationary, reducing costs and reshaping labor markets. Dalio's The Changing World Order delves into how shifts in economic and political power among nations, combined with excessive debt, often result in conflict and restructuring of global dominance. Howell's Capital Wars examines the geopolitical struggles over financial supremacy and global liquidity, highlighting how capital flows and credit cycles affect economies worldwide. Meanwhile, Raoul Pal's thesis on exponential technology, blockchain, and crypto envisions decentralized finance as revolutionary and a disruptor to the existing debt-driven monetary system, potentially redefining wealth and economic structures. Together, these theories illustrate a world where deflationary technology clashes with inflationary monetary policies, pushing governments toward extreme measures like hyperinflation in asset markets to maintain economic balance, all within a period of crisis and potential transformation. These intersecting forces, deflation from technology, inflation from monetary policies, geopolitical realignments, and shifts in capital flows, are driving profound changes in wealth distribution, economic structures, and societal dynamics. While technology has made it possible for some costs to decline, it simultaneously disrupts labor markets and adds pressure to already fragile economic systems. Central banks and governments facing these deflationary pressures often respond with inflationary policies, leading to inflated asset prices, currency debasement, and widening inequality. Howell's focus on capital flows and global liquidity, paired with Dalio's exploration of shifting world orders, underscores the geopolitical tensions and financial struggles that further complicate this backdrop. Raoul Pal's focus on blockchain and crypto adds another layer to the story, suggesting that decentralized finance could either challenge or offer a solution to the current monetary system's vulnerabilities. Ultimately, understanding these complex dynamics is crucial for navigating the challenges and opportunities of the coming decade. Whether through economic reforms, transformative technologies, shifts in global power, or a potential restructuring of the financial system, the 2030s will be a defining period. The battle between deflationary technology and inflationary policies, combined with cyclical societal crises and capital wars, sets the stage for significant shifts in the global order, potentially resulting in a new financial and social landscape for us all.